Key ideas in quantitative finance: options. Options go back a long way in history. In fact, the first references to the idea of having a contract in the form of an option goes back to the works of Aristotle in 350 before Christ. Aristotle describes an anecdote of his acquaintance, the philosopher Thales of Miletus, in which this philosopher knew by his skill in the stars, as it's written in Aristotle's Politics, that there will be a good harvest next year. So what did Thales did? He entered into a contract with the people who would have the oil press in the island of Miletus, and he gave a small price, a small premium today, so that he will be able to rent them next year. When the next year arrived, and indeed there was very good weather and very good harvest, and everyone wanted to make olive oil, and they wanted to use the presses, but no one could use them because he, Thales, had agreed to hire them for a low price 1 year before. So he had the option to let them away to other people at any price he wanted. This is an option contract. And this idea indeed is been with us for a very long time, the possibility of buying or selling something in the future. Indeed, the financial markets started trading specifically options in the 1970s. In 1973, a very important year in which we had the first exchange, the Chicago Board of Options Exchange, entirely dedicated to trading options. But of course, options have traded in different exchanges before that, and informally all the way to the time of Aristotle in the past. Why? Well, because it is a very interesting contract. It's a contract which is defined in this way. An option is a contract which gives the buyer the right, but not the obligation, to buy an asset, the underlying, for a predetermined price, strike price, at a predetermined date in the future, the maturity. At inception, the buyer must pay a premium in order to be able to enter into this contract. So what we're doing here is that we pay a little bit today, such that will give us the opportunity, the option to buy or to sell something in the future. In fact, the key variables here, therefore, are the price of the underlying, in particular at maturity, S capital T, the maturity time, capital T, the strike price, K, and the premium, which is the Greek letter pi. So compared with the spot contract, in which everything happens at the present, you pay the money, you get the thing today. In the option contract, this is different because today we pay a small premium, which is the cash flow going down at time zero. And in exchange of that, we get a contract, an option contract. This option contract is going to give us the possibility at maturity to buy something for a certain price. Which price? The price I agreed in the contract. This price is the strike price. And in exchange for that price, for this cash flow, which is K in here, we're going to get the underlying at maturity. This is a contract which has optionality. That event in the future might happen or might not happen. But who decides if it happens or not? I decide. I pay the premium, and therefore I decide if in the future I'm going to buy that thing for that price. I who have the contract. The pricing, therefore, should consider the cash flows involved, and at time zero, there's an exchange. I pay the premium, and I get the contract, and this contract is going to allow me at maturity, T equals capital T, to do one of two things. To either not exercise the option, that is, throw it away, or to exercise the option and indeed give the cash flow, give the cash K, and receive the underlying. How do I decide if I do one or the other? If I actually buy this thing for K or I do nothing? Well, it depends on the value of the ST, the value of the object I want to buy in the future. If we compare it with the forward or the futures contracts, there was no choice. I decided to buy something for some price in the future. When the future arrives, I have to do that. I might lose money, I might make money, but then I have to do it. In the option contract, I have the option. I paid, in fact, at inception, such that in the future I can decide if I buy it or not. I can buy it if I'm going to make a profit. I will do nothing if I'm going to make a loss, if I would do it. And therefore I decide to do nothing. This makes that the payoff of an option, in particular the call option contract, which gives the right to buy the underlying in the future, has this shape, this asymmetric shape. Because if the value of the underlying, represented in the lower part, in the horizontal axis, ST, is higher than the strike price, then it is a good deal and I should exercise. I should give K and I should get the thing, because the thing, the underlying, costs more than the strike price. But having a right maturity, if the price ST is less than K, then I should do nothing, I should not exercise, and then I can throw away the contract, and therefore the payoff will be zero, doing nothing. This is represented mathematically, this shape of the payoff, with the formula H equals max ST minus K and 0, which allows to do all forms of calculations to compute the right price of this type of contracts. This is done again through the no arbitrage argument, in which the sum of the cash flows should be 0. And by doing this, we can simply look at the cash flows and add the cash flows at time 0. So which cash flow do I have? I have the premium at time 0 is paid, therefore it's negative, minus pi, plus another set of cash flows that will happen in the future. They might happen in the future, and therefore this is denoted by max ST minus K and 0, the payoff of the call option. But wait, that cash flow is optional. It's a cash flow that is uncertain. It might happen or not. Being a random variable, the way to handle random variables is to compute the expected value. And that's why here, to give a value to that cash flow in the future, we compute the expectation of the payoff. But this is a cash flow in the future, so to bring it to the present, we need to multiply it by the discount factor, df capital T, as we have here. We add these cash flows and we equate them to 0 for fair pricing. And if we rearrange this formula, we obtain the last formula we see in this page in the bottom, which is very important for quantitative finance, in particular for the pricing of options, which says that pi equals the exponential of minus RT times the expected value of the max of ST minus K and 0. If we traduce that to English, what this says is that the option price, how much I should pay for the option, should be equal to the discounted expected payoff. That is, how much I should pay today for an option should be equal to how much I expect to get in the future for this contract, discounted to the present, and this expectation considered in a statistical sense. There are different types of options. A call option gives the right to buy. A put option gives the right to sell. A long option is when we buy the option, we pay the premium, but if the cash flows are exchanged, we have a short option in which we sell the option and we receive the premium. And we have options that can be exercised only at maturity. These are the European options. And options that can be exercised anytime before maturity, which are the American options.